Welcome to the beginning of your journey toward becoming a true professional in the tax surplus funds industry. Our mission is to help you build a well-rounded knowledge base, enabling you to go beyond just being a basic finder who focuses solely on surplus funds. Instead, you'll be equipped to have meaningful, professional conversations with homeowners, whether they are facing pre-foreclosure or have already gone through the foreclosure process. In this video, we'll introduce you to the key statutes and breakdowns that govern tax foreclosures in California. By understanding these laws, you'll be able to answer the important questions homeowners may ask, making you a trusted and informed resource. If there's ever a question you can't answer right away, you'll know exactly where to go. Our website is fully categorized by state statute, making it easy for you to research and review any information, complete with links to the full text of the statutes themselves. We want to congratulate you for taking this important step toward becoming a well-informed professional in this field. In this video, you'll get a small glimpse of the kinds of statutes you'll need to master, covering everything from tax default notices to the final distribution of surplus proceeds. You'll notice that we save the statutes on distributions for last because they deal with the outcomes and aftermath of everything you've learned along the way. By the end of this video, you'll feel empowered with a deeper understanding of the full spectrum of tax foreclosures in California. You'll have a clearer picture of the entire process, from the initial stages of delinquency all the way through to the distribution of funds, making you a more confident and capable professional in this industry. Review of California Revenue and Tax Code Section 3351. Notice of Impending Default. Summary for Finders. Section 3351 outlines the procedure for the annual notice of impending default for unpaid property taxes. This section is important for finders as it relates directly to how and when properties may move into a tax default status, which can lead to the creation of surplus funds. Annual Notice Requirement. By June 8 each year, the tax collector must publish a notice of impending default for properties with unpaid taxes. This includes taxes, assessments, penalties, and costs that are not fully paid by the close of business on June 30th, or the next business day if that date is a holiday or weekend. Reminder and redemption notices. If the tax collector sends reminder notices for unpaid taxes or redemption notices for prior year's delinquent taxes, the default notice only applies to properties that have been delinquent for 3 or more years. This is especially relevant if previous notices were undeliverable. Relevance to finders. Understanding this timeline helps finders pinpoint when properties may fall into default and when surplus funds could become available after a tax sale. Being aware of how and when properties enter this process allows finders to request the tax surplus list from the county at the appropriate time, making their conversations with homeowners informed and professional. Key takeaways. The Notice of Impending Default is published annually, offering a clear timeline for when properties are at risk. Properties that have been delinquent for 3 or more years may be more likely candidates for tax sales and potential surplus funds. Professional finders must grasp these timelines and processes to effectively identify surplus fund opportunities. By familiarizing yourself with these procedures, you'll enhance your expertise and stand out as a knowledgeable professional in the tax excess proceeds business. Review of California Revenue and Tax Code Section 3352. Notice of Default. Overview for finders. Section 3352 outlines the formal requirements for the notice of impending tax default. This statute is important for finders to understand the official process that leads properties into tax default status and eventually toward tax sales. Having this knowledge allows finders to navigate both pre-foreclosure and post-foreclosure stages with greater professionalism. Form and details of the notice. The notice is presented as an affidavit and includes key information to inform the public about the potential tax default. The information provided here helps finders track which properties are at risk of default and eventual tax sale. Key points covered by the notice. Default warning. The notice warns that if the taxes are not paid, the amount due will officially be in default. Timing of default. It specifies when the default will legally occur. Redemption opportunities. Property owners are informed they can still redeem their property by paying the defaulted amount, penalties, and fees, or entering an installment plan. Sale of property. If the property is not redeemed, it will be sold to satisfy the tax lien. Publication of defaulted properties. A list of all properties in tax default will be published by September 8 unless redeemed before that date. Relevance to finders. For finders, understanding this statute is valuable because it outlines the timeline and steps leading to a tax sale. By recognizing when and how properties fall into default, finders can better identify pre-foreclosure opportunities and access county surplus funds lists after the sale. Pre-foreclosure strategy. Finders working in the pre-foreclosure space can use this information to reach out to homeowners before the property is sold. This approach allows them to build trust and open meaningful discussions about the tax sale process. It is key to stay ahead by being the first to speak with homeowners about the potential consequences of tax default. By showing a willingness to help with the broader process, not just surplus funds, finders can position themselves as professionals. Post-foreclosure focus. Once properties are sold and surplus funds are generated, finders can shift their attention to helping claim those funds. Counties often verify surplus funds and maintain lists that finders can directly request. Key takeaways. Understanding the tax default process is vital for finders, allowing them to act both before and after a sale. Professionalism is demonstrated by knowing how to discuss the entire tax foreclosure process with homeowners, not just focusing on surplus funds. The more finders grasp the nuances of delinquent tax law, the better they can serve homeowners and stand out in the business. This statute provides a foundational understanding of how properties move toward tax sales, helping finders stay informed and maintain a professional edge. Review of California Revenue and Tax Code Section 3353. Publication of notice. Overview for finders. Section 3353 explains how the notice of tax defaulted properties is published in the county. This is relevant for finders because it informs them about how counties make this information publicly available, which finders can use to identify properties that may be heading toward tax sales and, eventually, surplus funds. Method of publication. The notice of impending tax default must be published in accordance with Section 6063 of the Government Code. Typically, this means the notice is published in a local newspaper of general circulation within the county. If there is no local newspaper, the notice will be posted in 3 public places within the county. Publication costs. The costs for publishing the notice are capped at a rate set by the county's Board of Supervisors for other county advertising. This is more of an administrative detail, but it's useful for finders to know that the process is regulated and formalized. Relevance to finders. Understanding this statute gives finders insight into how the county makes tax defaulted property information available to the public. This is particularly important for finders working in the pre-foreclosure space, as it helps them stay ahead by accessing information on properties that may soon be available for auction. Pre-foreclosure opportunity. Finders who track these publications can identify properties before they go to tax sale. This allows them to approach homeowners and discuss the foreclosure process in a meaningful way, offering assistance with the full scope of their tax issues, not just surplus funds. Post-foreclosure lists. After a property is sold at auction, finders can request the tax surplus list from the county. Understanding where and how the county publishes this information allows finders to stay informed and act quickly to assist homeowners in claiming surplus funds. Key takeaways. Counties publish notices of tax defaulted properties in local newspapers or by posting in public places. Finders who follow these publications can stay ahead in pre-foreclosure cases, making it easier to establish professional relationships with homeowners. Accessing this published information can lead to better opportunities for finders to identify surplus funds once the foreclosure process is completed. This section reinforces the importance of knowing where to find relevant data on tax defaulted properties, helping finders become more knowledgeable and professional in the tax excess proceeds industry. Review of California Revenue and Tax Code Section 3361. Publication of Notice of Power and Intent to Sell Tax Defaulted Property. Overview for finders. Section 3361 requires the tax collector to annually publish a notice of intent to sell tax defaulted properties on or before June 8. This notice signals the upcoming sale of properties that have been in tax default for a specified number of years. Understanding this publication process is essential for finders, as it provides insights into which properties are entering the tax sale stage. 5-year default. Properties that have been in tax default for 5 years or more are the most common types listed for sale. These properties are often sold at public auctions, where any surplus funds from the sale become available for claim. Finders working in this space need to track these sales to know when surplus funds may be generated. 3-year residential properties. Some residential properties in default for 3 or more years may also be included if they are identified for public benefit, such as housing for low-income individuals. These properties are sold at auction by request of local governments or nonprofits. 3-year non-residential commercial properties. In certain counties, non-residential commercial properties that have been in tax default for 3 or more years are also sold at public auction. Though less common, these properties may result in surplus funds that finders can help recover. Conclusion for finders. The annual publication of tax defaulted properties, mandated by Section 3361, serves as a key resource for finders working both pre-foreclosure and post-foreclosure. Those who focus on pre-foreclosures can use this information to stay ahead by identifying properties approaching sale and initiating meaningful conversations with homeowners. This proactive approach builds trust and positions finders as professionals who understand the entire foreclosure process. In the post-foreclosure stage, finders can use these publications to track auctions and request surplus fund lists from the county, assisting homeowners in recovering their funds after the sale. By knowing how and when properties are listed for auction, finders enhance their expertise in the field and open up more opportunities to help homeowners. Review of California Revenue and Tax Code Section 3362. Content of published notice. Overview for finders. Section 3362 details the required content of the published notice regarding tax defaulted properties. This notice is essential for finders who monitor upcoming tax sales and look for opportunities to assist homeowners in both pre-foreclosure and post-foreclosure stages. Key information in the notice. The notice includes several critical pieces of information about the property and the tax sale process. Date of the notice. Establishes the timeline of when the notice is published. Time elapsed since default. The notice will indicate whether the property has been in default for 5 years, 3 years for certain commercial properties, or 3 years for properties that could benefit low-income housing. Impending sale. It warns that unless the property is redeemed or placed under an installment plan, it will be sold for non-payment of taxes. Termination of redemption rights. It specifies that if the property is sold, the right to redeem it will end. Redemption information. Provides the contact information of the official responsible for redemption inquiries. Tax information and property details. The notice includes the fiscal year of default, the description and street address of the property, the amount required for redemption, and the name of the current assessee. Relevance to finders. Understanding the contents of this notice allows finders to accurately track which properties are nearing tax sale. For those working in pre-foreclosure, the detailed timeline in this notice gives finders the chance to approach homeowners early, offering assistance with the redemption process or explaining the potential consequences if taxes remain unpaid. This type of proactive engagement helps finders stand out as professionals who understand the entire foreclosure process. In the post-foreclosure stage, this notice is crucial because it signals that properties are about to be sold at auction. After the auction, surplus funds may become available, and finders can request surplus lists from the county to assist homeowners in claiming those funds. By understanding the timeline and content of these notices, finders can stay ahead in their research and offer meaningful assistance. Conclusion. Section 3362's detailed requirements for tax sale notices provide finders with all the necessary information to monitor tax defaulted properties. By keeping track of these notices, finders can take advantage of opportunities both before and after tax sales. In pre-foreclosures, they can position themselves as knowledgeable professionals who help homeowners through the entire process. In post-foreclosures, they can use the county's surplus funds lists to assist in recovering funds for homeowners. Having a solid grasp of these processes helps finders elevate their expertise and credibility in the tax excess proceeds business. Review of California Revenue and Tax Code Section 3365. Mailing of Notice of Default and Power to Sell. Overview for finders. Section 3365 requires that after the first publication of the notice, the tax collector must send a registered letter to the last known owner, assessee, of a tax defaulted property. This letter informs the owner of the default and the power to sell the property due to unpaid taxes. For finders, understanding this process is crucial for identifying when properties are approaching a tax sale and when surplus funds might become available. Mailing requirements. The tax collector must mail the notice 21 to 35 days before July 1st. This time frame ensures that the property owner is given reasonable warning before the property is sold. The notice is sent by registered mail to the last known address of the property owner. The tax collector is obligated to make reasonable efforts to find the owner's current address, including checking property assessment rolls, local telephone books, and records in the county where the property is located. Validity of sale. If the tax collector fails to make a reasonable effort to locate the owner's address, this does not affect the validity of the tax sale. The sale can proceed regardless of any failures in this regard. Bankruptcy notification. If the property is involved in a bankruptcy case, this mailed notice serves as an official notice of tax deficiency under federal bankruptcy law, which protects the tax collector's right to sell the property despite the bankruptcy proceedings. Conclusion. For finders, Section 3365 highlights a key part of the pre-foreclosure process where property owners are formally notified of the impending sale. This is an important time for finders working in pre-foreclosures to approach homeowners and offer their expertise, providing information about redemption options and the consequences of a tax sale. By reaching out to owners during this window, finders can engage in professional, meaningful conversations before the property is lost to auction. For finders focused on post-foreclosure, understanding this notice period is essential because once the sale occurs, surplus funds may be available. Counties often keep verified lists of these funds, which finders can request to assist homeowners in claiming what's rightfully theirs. By staying informed about this mailing process, finders can time their outreach effectively, whether they're assisting with preventing a sale or recovering surplus funds after the fact. Review of California Revenue and Tax Code Section 3371. Publication of affidavit and list of real property. Overview for finders. Section 3371 establishes the requirement for the tax collector to publish an affidavit and a list of properties that are in tax default. This annual publication is a key resource for finders, as it offers insight into which properties are approaching or have already passed the default period, signaling potential tax sales and opportunities for surplus fund recovery. Publication requirements. By September 8 each year, the tax collector must publish a notice of all properties where taxes, assessments, penalties, and costs have not been paid, putting them in default. This list must include all real property in default. Counties with delinquent notices. In counties where delinquent notices are mailed to property owners before June 30th, the tax collector still publishes the list of tax defaulted properties by September 8th, but it may reflect properties from the year following the default date. Targeted properties for publication. 3 or more years of delinquency. If the tax collector sends reminder notices and annual redemption notices, the publication may be limited to properties that have been delinquent for 3 or more years. This is especially the case if the most recent reminder or redemption notice was returned as undeliverable. Conclusion for finders. For finders, Section 3371 outlines the annual publication of tax defaulted properties, which serves as a crucial resource for identifying both pre-foreclosure and post-foreclosure opportunities. Those who track this publication stay ahead by targeting properties that are nearing sale or have recently passed into default. In pre-foreclosure, finders can engage with homeowners about their tax delinquency, providing assistance with redemption options and showing professionalism by understanding the full scope of delinquent tax laws. In post-foreclosure, finders can request surplus fund lists from the county once these properties are sold, helping homeowners recover excess funds. By understanding the publication timeline and contents, finders can position themselves as informed professionals and maintain meaningful conversations with homeowners. Review of California Revenue and Tax Code Section 3372. Content of Notice. Overview for finders. Section 3372 outlines the specific details that must be included in the notice regarding tax defaulted properties. This notice, referred to as the Published Delinquent List, is vital for finders as it provides essential information about properties in default, which may lead to future opportunities for assisting with surplus funds recovery. Affidavit of Tax Default. The notice includes an affidavit stating that the property is in tax default. This is a formal declaration that the property has not met its tax obligations. Redemption options. The notice informs property owners that they can redeem the property by paying the outstanding taxes, penalties, and fees. It also explains that redemption can occur through an installment plan, which is an opportunity for finders working in pre-foreclosures to assist homeowners before the property is sold at auction. Key information provided. The notice contains official contact for redemption. The notice lists the name and office of the official responsible for providing redemption information. Property details. This includes the name of the current assessee, a description of the property, and the total amount required to redeem the property by a specified date. Published delinquent list. The list includes all tax defaulted properties unless they have been redeemed. If a property is redeemed, its information can be omitted from the publication. Conclusion for finders. Section 3372's content is vital for finders, providing a clear breakdown of the information published about tax defaulted properties. This published delinquent list helps finders identify pre-foreclosure opportunities, where they can assist homeowners in redeeming their properties by discussing payment or installment options before the property goes to auction. Once a property moves to post-foreclosure, finders can shift their focus to surplus funds recovery, knowing that the county keeps track of these funds for properties that are sold. This statute helps finders stay informed, allowing them to approach homeowners professionally and offer meaningful assistance across both pre- and post-foreclosure stages. Review of California Revenue and Tax Code Section 3376. Information for the preparation and enforcement of property sales. Overview for finders. Section 3376 covers the exchange of information between the tax collector and the controller to enforce property sales for tax defaulted properties. Understanding this process is important for finders because it gives insight into how properties move through the sale stage, particularly when preparing for auction and determining the minimum bid, which can affect the generation of surplus funds. Information sharing for property sales. The tax collector can request information from the controller necessary to prepare and enforce the sale of tax defaulted properties, including details like social security numbers. This information helps the tax collector process the sale, but it is not public information and is kept confidential. The tax collector must certify that the requested information is needed specifically for preparing the sale, ensuring that this process is tightly regulated. Minimum bid and tax postponement loan. If a property has an outstanding property tax postponement loan, the tax collector or assessor must include this amount in the minimum bid for the property at the sale. In cases where the property fails to meet the minimum bid, the bid may be reduced, and any funds collected are proportionately allocated between the county tax collector and the controller's office. Conclusion for finders. Section 3376 outlines the mechanics behind the preparation and enforcement of tax defaulted property sales, which finders need to understand when working in both pre-foreclosure and post-foreclosure stages. Finders focused on pre-foreclosures can monitor properties that are nearing auction, recognizing that the minimum bid may include outstanding loans, which affects the overall sale price. In post-foreclosure, once the sale is complete, finders can request surplus funds lists from the county. The inclusion of property tax postponement loans in the minimum bid may also influence the amount of surplus generated. By understanding how this process works, finders can better position themselves as knowledgeable professionals and engage meaningfully with homeowners before and after the sale. Review of California Revenue and Tax Code Section 3442. Furnishing auditor with list of tax defaulted property. Overview for finders. Section 3442 requires the tax collector to provide the county auditor with a list of all tax defaulted properties within 30 days after a property is declared in default. This statute is important for finders as it marks the official recording of tax defaulted properties, which is a key step before properties may proceed to auction and potentially generate surplus funds. Timeline for submission. The tax collector must furnish the auditor with the list of tax defaulted properties within 30 days of declaring them in default. This list becomes part of the official records, ensuring the tax default status is noted for each property. Recording the default. The county auditor must immediately enter the fact and date of the tax default declaration on the current roll. This public record indicates that the property is in default and begins the process that could eventually lead to a tax sale if the taxes remain unpaid. Conclusion for finders. Section 3442 establishes an important early step in the foreclosure process by officially recording tax defaulted properties. For finders working in pre-foreclosures, this statute highlights the importance of tracking properties soon after they are declared in default, allowing finders to contact homeowners before their property moves to auction. In the post-foreclosure stage, Understanding when properties are officially declared in default helps finders anticipate when these properties may be sold at auction and potentially generate surplus funds. Staying informed about these timelines enhances a finder's ability to provide professional, timely assistance to homeowners. Review of California Revenue and Tax Code Section 3451. Method of payment for tax defaulted property. Overview for finders. Section 3451 gives the tax collector the authority to accept various methods of payment for tax defaulted properties, whether these properties are being redeemed or sold at public auction. This statute is relevant for finders because it highlights the flexibility in payment options during tax default sales, which can affect how quickly a property is redeemed or sold, potentially influencing the timeline for surplus fund generation. Payment flexibility. The tax collector can decide to accept different payment methods, as authorized by Sections 2502, 2503.2, and 2504, when dealing with tax defaulted properties. These options may include cash, checks, electronic transfers, or other methods. For finders, knowing that flexible payment methods are available can assist in guiding homeowners through the redemption or auction process, giving them more options to settle their tax obligations. Impact on property redemption and sale. Flexibility in payment methods can streamline the redemption or sale process, ensuring that homeowners or buyers can complete transactions more easily. This can either prevent a tax sale, if the owner redeems the property, or hasten the sale, which could lead to the generation of surplus funds after the auction. Conclusion for finders. Section 3451 offers insight into the tax sale process by emphasizing the variety of payment methods that may be accepted by the tax collector. For finders working in pre-foreclosures, this knowledge can help them advise homeowners on how to redeem their property, making the process smoother and less daunting. In post-foreclosure scenarios, once a property is sold at auction, the flexibility in payment methods could expedite the sale, leading to faster availability of surplus funds, which finders can help homeowners claim. Understanding these payment options allows finders to approach both pre- and post-foreclosure situations professionally, demonstrating a well-rounded knowledge of the tax sale process. Review of California Revenue and Tax Code Section 3456. Claim against bidder. Notice. Overview for finders. Section 3456 addresses situations where a bidder on a tax-defaulted property fails to pay their bid in full. This statute outlines the consequences for bidders who do not complete their payment, including the county's right to recover costs and the potential penalties imposed on the bidder. For finders, this is relevant in understanding how tax sales work, what happens when a bidder defaults, and how this can impact the timeline for surplus funds or the resale of the property. Consequences of delinquent payment. If a bidder does not pay the full amount of their accepted bid, the county is entitled to claim the actual cost of the sale from the bidder. The tax collector must notify the bidder by certified mail, and this notice will include the voiding of the bid due to delinquent payment, the amount the county is claiming for the sale costs, information that the county will deduct the amount owed from any deposit made by the bidder, with any remaining deposit forfeited, further actions if payment is not made. If the bidder fails to pay the county's claim within 30 days of receiving notice, the county can use legal means, such as adding the claim to the unsecured tax roll, to collect the owed amount. The tax collector may prohibit the bidder from participating in future tax sales for up to 5 years. Conclusion for finders. Section 3456 provides key insights into how the county handles situations where bidders default on their accepted bids. For finders, this information is useful when navigating post-foreclosure opportunities, as it may affect the availability of properties for sale or the generation of surplus funds. If a bid is voided, the property may return to auction, creating another chance for surplus funds to be generated. Additionally, understanding these processes can help finders educate homeowners or clients about the integrity of the tax sale process, further enhancing their professional standing in the tax surplus industry. Review of California Revenue and Tax Code Section 3691. Power to sell. Overview for finders. Section 3691 outlines when and how tax-defaulted properties may be sold by the tax collector. For finders, this statute is key because it sets the timeline and conditions under which properties become eligible for tax sales. Knowing these details helps finders identify potential pre-foreclosure opportunities and understand when properties may generate surplus funds following their sale. Timeline for sale. 5 years after default. Generally, the tax collector has the power to sell a property if it has been tax defaulted for 5 years or more. For non-residential commercial properties, the timeline is reduced to 3 years. Once this period has passed and the property has not been redeemed, the tax collector can sell it at auction. Disaster tolling. If the property has been damaged by a disaster and has not been substantially repaired, the 5-year default period is extended until 5 years after the disaster occurred. Sale conditions. Any person may purchase a tax-defaulted property at auction, regardless of prior liens or claims on the property. When only part of a tax-defaulted property is sold, the unsold portion remains subject to redemption and will be valued separately. Special circumstances. The county may adopt conditions to delay the sale of properties that may be eligible for a property tax postponement program. Properties requested by a city, county, nonprofit, or an entity with a nuisance abatement lien may be sold after 3 years of tax default, even if they have not reached the 5-year default mark. Notice requirements. The tax collector must provide notice of an intended sale as specified by law, including sending mail notices to relevant parties such as lien holders, mortgages, and taxing agencies. These notices must be sent 45 to 120 days before the sale. Conclusion for finders. Section 3691 is a key statute for finders, providing the framework for when properties are eligible for sale and when they might generate surplus funds. In pre-foreclosure, finders can assist homeowners before their property reaches the 5-year or 3-year default period, educating them about redemption options. For post-foreclosure, once a property is sold, finders can focus on surplus funds that may be available. By understanding the timelines, sale conditions, and notice requirements, finders can stay ahead and offer informed, professional assistance to homeowners at different stages of the tax default process. Review of California Revenue and Tax Code Section 3691.1. Notice. Overview for finders. Section 3691.1 requires the tax collector to issue a notice when a parcel becomes subject to the power of sale under Section 3691. This notice is an important step in the foreclosure process, as it officially marks a property as being eligible for tax sale. For finders, understanding when and how this notice is executed helps in tracking properties that are approaching sale and could lead to surplus funds after the auction. Execution of the notice. The tax collector must execute a formal notice on a form prescribed by the controller once a property becomes subject to sale due to tax default. This notice is essential for formally marking the property as eligible for sale. The county clerk must acknowledge this notice without charging any fees, ensuring the process is accessible and streamlined for the tax collector. Bankruptcy proceedings. If the property is involved in a bankruptcy proceeding, this notice serves as a notice of tax deficiency under federal bankruptcy law. This provision allows the tax sale process to move forward, even if the property owner is under bankruptcy protection, by notifying relevant parties of the tax obligations. Conclusion for finders. Section 3691.1 provides a clear signal for finders that a property is officially eligible for sale due to tax default. This is a critical step in the process that can lead to the generation of surplus funds. For finders working in pre-foreclosures, tracking when this notice is executed can provide a window of opportunity to assist homeowners before the property is sold. For post-foreclosure opportunities, once the property is sold at auction, finders can pursue surplus funds by requesting county surplus lists. Understanding the notice process enhances a finder's ability to stay ahead and offer professional guidance to homeowners during these pivotal moments. Review of California Revenue and Tax Code Section 3691.2. Content of Notice. Overview for finders. Section 3691.2 outlines the specific information that must be included in a notice when a property becomes subject to sale due to tax default. This is essential for finders, as it provides clear details about the status of the property, the timeline for sale, and the amount owed. Understanding the content of these notices helps finders stay informed and act appropriately when assisting homeowners or pursuing surplus funds. Key information in the notice. Elapsed time since default. The notice must state whether 5 years or 3 years for non-residential commercial property, have passed since the property was declared in tax default. In some cases, the notice will indicate that 3 years have passed, and a request has been made by a city, county, or nonprofit to sell the property. Assessment and legal tax levy. The notice affirms that the property was legally assessed for taxation and that the tax was legally levied. Subject to sale. It must clearly state that the property is subject to sale for non-payment of taxes. Outstanding taxes. The notice specifies the original amount of taxes declared in default. If any portion has been canceled, redeemed, or corrected, the remaining balance is indicated. Property description. The notice includes a detailed description of the property, using either a meets and bounds or lot block tract format, ensuring the property is clearly identified. Conclusion for finders. Section 3691.2 provides essential details that mark a property as subject to sale for unpaid taxes, which is important for finders tracking pre-foreclosure properties. This notice serves as a formal declaration that the property is on the path to auction, and it gives finders the chance to assist homeowners before the sale occurs. For finders working in post-foreclosure, understanding the timeline and amounts owed helps them prepare to request surplus funds from the county once the property is sold. By grasping the content of these notices, finders can stay informed and maintain a professional approach when working with homeowners at any stage of the tax sale process. Review of California Revenue and Tax Code Section 3691.4. Recording of notice. Overview for finders. Section 3691.4 requires that the notice of tax defaulted property, once prepared, be officially recorded with the county recorder. This recording is an important step in the foreclosure process, as it ensures that the tax default status is formally documented in public records. For finders, understanding when and how this notice is recorded helps track properties nearing auction and anticipate opportunities for surplus fund recovery. Recording requirement. The notice must be recorded with the county recorder. This step ensures that the public record reflects the property's tax default status, providing transparency and an official record for all interested parties. Once the notice is recorded, it is forwarded to the tax collector, ensuring that the tax collector has a complete record of the property's status. No charge for recording. The county recorder is prohibited from charging a fee for recording this notice. This ensures that the process is straightforward and without additional costs to the tax collector, facilitating the efficient handling of tax defaulted properties. Conclusion for finders. Section 3691.4 highlights an important administrative step in the tax sale process, providing finders with insight into when a property's default status becomes part of the public record. For those working in pre-foreclosures, the recording of this notice serves as a signal that the property is approaching a sale, allowing finders to step in and assist homeowners before the auction takes place. For finders focused on post-foreclosure, understanding this recording process helps them anticipate when properties will be auctioned and potentially generate surplus funds. Knowing when a notice is recorded allows finders to stay ahead and offer professional, timely assistance. Review of California Revenue and Tax Code Section 3692. Attempt to sell tax defaulted property. Overview for finders. Section 3692 details the process by which the tax collector is required to attempt the sale of tax defaulted properties. This statute is critical for finders, as it explains how often properties must be put up for sale and provides insight into the specific types of properties that may be sold under unique conditions. Understanding these processes helps finders anticipate auction cycles and track properties that may eventually lead to surplus funds. Time frame for sale. The tax collector must attempt to sell tax defaulted property within 4 years of the property becoming subject to sale. If no acceptable bids are received, the tax collector must continue to attempt sales at least every 6 years until the property is sold. This ensures that tax defaulted properties are regularly offered for sale. Special sale conditions. Oil, gas, or mineral rights. If these rights are being sold due to non-payment of taxes, the tax collector may offer them to holders of other interests in the property, partial or full owners. Unusable parcels. Small or otherwise unusable parcels may be sold to adjacent property owners or those holding easements, with the condition that the buyer combines the parcel with their existing property. This provision ensures that unusable parcels are not left unsold for extended periods. Sealed bid sales. For the sale of oil, gas, mineral rights, or unusable parcels, sealed bid procedures must be used. The property is sold to the highest eligible bidder, and the process allows for a period of 30 days or more for bids to be submitted. Reoffering of unsold properties. If a property remains unsold, it can be reoffered for sale within 90 days, and any new parties of interest must be notified. This provision ensures that unsold properties are not left idle for long periods and allows for multiple attempts to sell. Conclusion for finders. Section 3692 provides a comprehensive view of how and when tax-defaulted properties are sold, giving finders clear guidance on the sale cycles and special conditions that may apply. For finders focusing on pre-foreclosure, knowing the timelines for these sales allows them to engage homeowners before the property is offered at auction. In post-foreclosure, the regular reoffering of properties increases the chances for surplus funds to be generated, which finders can track and help homeowners recover. By understanding the nuances of sale attempts and sealed bid procedures, finders can maintain a professional approach, offering homeowners well-informed guidance throughout the process. Review of California Revenue and Tax Code Section 3692.2. Public auction conducted by electronic media. Overview for finders. Section 3692.2 allows public auctions for tax-defaulted properties to be conducted through electronic media, including the Internet. This statute is important for finders, not because they are expected to bid on properties, but because it offers insight into how tax sales are increasingly moving online. Understanding the mechanics of these online auctions helps finders stay informed about when properties are sold, which may lead to surplus funds that they can help homeowners recover. Electronic bidding component. The auction process must include a component that allows bids to be submitted online. This modernizes the auction process, making it more accessible to bidders who can participate from anywhere. For finders, it's key to understand that properties sold in this manner could result in surplus funds if the sale exceeds the amount owed in taxes. Flexible auction timeframes. The tax collector has the discretion to keep the bidding open as long as necessary. This flexibility means that online auctions may run for varying periods, which impacts when properties are sold and when surplus funds might become available for recovery. Conclusion for finders. Section 3692.2 reflects the growing trend of conducting tax-defaulted property auctions online. While finders are not involved in bidding, understanding the timeline and structure of these auctions is essential. Once properties are sold, surplus funds may be generated, and finders can use this information to assist homeowners in recovering those funds. Staying informed about how online auctions operate ensures finders are better equipped to serve their clients professionally and effectively. Finders can also use tax-defaulted auction lists to determine which properties are being offered for unpaid taxes. Review of California Revenue and Tax Code Section 3692.4. Request to bring residential real property to next scheduled public auction. Overview for finders. Section 3692.4 allows a county, city, or nonprofit organization to request that the tax collector bring certain residential real properties to auction sooner than the standard 5-year timeline. These requests are typically for properties that have been delinquent for at least 3 years and that could serve the public by providing housing for low-income individuals. This statute is important for finders to understand, as it may impact the timeline for when properties are sold and when surplus funds could become available for recovery. Requirements for accelerated auction. The tax collector may accelerate the sale of residential properties that meet the following criteria. Property taxes have been delinquent for at least 3 years. The property can provide housing directly related to low-income individuals. The property is not occupied by the owner as their principal residence. Formal request process. A county, city, or nonprofit organization must submit a formal resolution from their governing board requesting the auction and stating the public benefit. The request must also include a written plan outlining how the property will be used or rehabilitated to serve low-income individuals. Deed restrictions for nonprofit acquisitions. If a nonprofit acquires the property at auction, a 30-year deed restriction must be placed on the property, ensuring it will be used for low-income housing. Alternatively, if the property is a single-family home sold to a low-income owner-occupant, the deed may provide for equity sharing upon resale. This arrangement allows the homeowner to retain their share of appreciation while the nonprofit recaptures any initial subsidy, which is then used to support other low-income buyers. Conclusion for finders. Section 3692.4 highlights an important process for expediting the sale of certain residential properties to benefit low-income housing initiatives. For finders, it is important to understand how this statute could affect the sale timeline for tax-defaulted properties. Properties that qualify for accelerated auction may lead to earlier opportunities for surplus funds once sold. By staying informed about this process, finders can better anticipate when properties will be auctioned and plan accordingly to help homeowners recover surplus funds. Additionally, being aware of these special circumstances helps finders maintain a professional approach when explaining the auction process to homeowners or interested parties. Review of California Revenue and Tax Code Section 3693, present until 2029, and Section 3693, effective 2029. Sale at public auction to highest bidder. Method of payment, deposit. Overview for finders. Both the current version of Section 3693, effective until January 1, 2029, and the version that will become operative on January 1, 2029, regulate the process by which tax-defaulted properties are sold at public auction. The key provisions in both versions outline how auctions are conducted, including the highest bidder process, payment methods, and the requirement for deposits. These statutes are important for finders working in post-foreclosure, as they provide insight into when properties are sold and how surplus funds may become available after a tax sale. Key provisions across both versions. Public auction to the highest bidder. In both versions, tax-defaulted properties are generally sold to the highest bidder at public auction. Payment methods authorized by other sections of the Code, Sections 2502, 2503.2, or 2504, are at the discretion of the tax collector, and unless otherwise specified, payment is due at the close of the auction. This ensures transparency and efficiency in the sale process. Deposits. Both versions allow the tax collector to require a deposit from potential bidders as a condition to participate in the auction. The deposit can also be applied toward payment for a specific property or multiple properties, depending on the minimum bid amounts. The deposit requirements must be publicly announced before the auction, giving bidders clarity on how much and when they must submit deposits. Public notice of deposit requirements. Both statutes require the tax collector to provide public notice about deposit requirements before the sale, including the method of payment, amount, and due date of the deposit. This ensures transparency and consistency in the auction process. Differences in the versions. The main difference between the current statute, effective until January 1, 2029, and the future statute, effective after January 1, 2029, is that the future version simplifies the language and eliminates specific provisions found in the current version. Notably, in the future version, sealed bid procedures allowed under Section 3692 are referenced, and there is no mention of specific intervals for attempting resale if the highest bidder fails to complete the sale. The time-sensitive provisions regarding what happens if a sale falls through, such as offering the property to the next highest bidder or what occurs if the auction is delayed by more than a year, are not present in the future version. Conclusion for finders. Both versions of Section 3693 guide the auction process for tax-defaulted properties and outline how deposits and payments must be handled. Understanding these statutes is important for finders, as properties sold at auction may result in surplus funds, which can be recovered by homeowners. By staying informed about how these auctions are conducted and how payment rules are enforced, finders can more effectively assist homeowners after properties are sold at auction. While the future version streamlines certain provisions, the core auction process remains consistent, ensuring a clear path for the sale and potential surplus recovery. Review of California Revenue and Tax Code Section 3698.5. Minimum price for sale of tax-defaulted property. Overview for finders. Section 3698.5 sets the minimum price at which tax-defaulted properties may be sold at public auction. This statute ensures that the sale price covers the necessary taxes, penalties, and costs associated with the property. For finders, understanding how the minimum price is calculated is important, as it affects when and how surplus funds may be generated after a property is sold. It also provides insight into the bidding process and potential resale opportunities if the property does not sell at the initial auction. Key provisions. Minimum price calculation. The minimum price for tax-defaulted properties includes the total amount necessary to redeem the property, plus costs and any outstanding balance of a property tax postponement loan. The total amount necessary to redeem is defined as the sum of defaulted taxes, delinquent penalties and costs. Redemption penalties. A redemption fee. Costs include various fees outlined in multiple sections of the Revenue and Taxation Code, which cover administrative and procedural costs. If there is an outstanding property tax postponement loan, the balance, interest, and associated fees must also be included in the minimum price. Reoffering of property. If a property does not receive any acceptable bids at the minimum price during the auction, the tax collector has the discretion, with the approval of the Board of Supervisors, to reoffer the property at a lower price based on the current assessed value or other unique circumstances. This ensures that properties are not left unsold indefinitely due to an inflated minimum price. Restrictions on current owners. Current owners of tax-defaulted properties are prohibited from purchasing their property at a price lower than the minimum price set by the tax collector. This provision ensures fairness and prevents owners from reclaiming their properties for less than the full amount of taxes, fees, and penalties owed. Conclusion for finders. Section 3698.5 establishes how the minimum price for a tax-defaulted property is determined before it can be sold at auction. This is particularly relevant for finders working in post-foreclosure, as the minimum price affects whether surplus funds may be generated from a sale. If the property sells for more than the minimum price, any excess becomes surplus funds, which finders can help homeowners recover. Additionally, understanding the resale process when a property fails to sell at the minimum price helps finders stay informed about future auction opportunities. Knowing the restrictions on current owners also ensures that finders can provide accurate guidance to clients about their legal limitations when it comes to repurchasing tax-defaulted properties. Review of California Revenue and Tax Code Section 3701. Notice of proposed sale to parties of interest. Overview for finders. Section 3701 outlines the notification process that the tax collector must follow before the sale of tax-defaulted properties. This section is crucial for finders, as it ensures that all parties of interest, those with a legal claim to the property or proceeds, are notified about the upcoming sale and their potential right to claim excess proceeds. Understanding this notification process helps finders track when properties are moving to auction and identify when surplus funds may become available for recovery. Key provisions. Notice requirements. The tax collector must send a notice between 45 and 120 days before the proposed sale to the last known address of all parties of interest, as defined in Section 4675. This includes individuals or entities with a legal or financial claim to the property. The notice must include the date, time, and place of the sale, the amount required to redeem the property, and information regarding the right to claim excess proceeds if the property is sold and generates surplus funds. Effort to locate parties of interest. The tax collector is required to make a reasonable effort to find the names and last known addresses of all parties of interest. This demonstrates due diligence on behalf of the tax collector, ensuring that all relevant parties are informed. Sale validity despite notification issues. If the tax collector cannot find a party of interest or if a party does not receive the notice, the validity of the sale is not affected, as long as the tax collector made a reasonable effort to notify all parties. This protects the sale from being challenged on the grounds of failed notification. Bankruptcy considerations. If the property is part of a bankruptcy proceeding, this notice serves as a notice of tax deficiency, allowing the sale to proceed despite the bankruptcy status under federal law. Conclusion for finders. Section 3701 is highly relevant for finders because it formalizes the notice process before a tax sale, ensuring that parties of interest are made aware of the sale and their right to claim any excess proceeds. For finders, this statute provides a clear window for when a property will be sold and when they can step in to help claim surplus funds. Additionally, knowing that a sale's validity is protected even if a party of interest is not found or does not receive the notice ensures that finders can focus on assisting with post-sale recovery, without concern that the sale might be reversed due to notification issues. Understanding this process allows finders to offer professional and timely assistance to homeowners and other parties of interest. Review of California Revenue and Tax Code Section 3702. Publication of Notice of Intended Sale. Overview for finders. Section 3702 mandates the public announcement of the intended sale of tax-defaulted properties through newspaper publications. This ensures that the sale is publicly known and provides a formal process to inform the community. For finders, understanding when and how the sale is publicized helps in tracking properties that are nearing auction and identifying potential surplus funds that could result from those sales. Key provisions. Publication in newspapers. The tax collector must publish a notice of intended sale once a week for 3 consecutive weeks in a newspaper of general circulation both in the county seat and the public notice district where the property is located. If one newspaper serves both areas or if it is determined that a single publication offers the best notice to the public, under Section 3381, that single publication will satisfy the requirement. If no newspaper is published in either the county seat or the public notice district, the notice can be posted in 3 public places in the county seat. Timing of publication. The publication must begin at least 21 days before the date of the sale, ensuring sufficient time for interested parties to learn about the auction. Governance of public notice districts. The publication of notice in a public notice district is governed by Chapter 1.1, commencing with Section 6080 of the Government Code, which standardizes the rules for public notices. Conclusion for finders. Section 3702 establishes the process by which the public is notified of upcoming tax-defaulted property sales through newspapers. For finders, this is an important step to monitor, as it signals that the property is moving to auction, and surplus funds may soon be available if the property is sold for more than the taxes owed. By keeping track of these public notices, finders can stay informed about which properties are nearing auction and position themselves to help homeowners or other parties of interest recover any resulting surplus funds. This statutory requirement provides transparency in the sale process, allowing finders to act in a timely and professional manner. Review of California Revenue and Tax Code Section 3704. Content of Notice of Intended Sale. Overview for finders. Section 3704 outlines the required content of the notice that tax collectors must provide before a tax-defaulted property is sold at auction. This notice serves as an official announcement of the sale and contains key details for anyone interested in the property or its sale outcome, including parties of interest who may have a claim to any excess proceeds. For finders, understanding the specific details in the notice is essential for tracking when a property is sold and determining when surplus funds might be available for recovery. Key provisions in the notice. Sale details. The notice must include the date, time, and place of the sale. If the sale is conducted online, the notice must provide the electronic address and details on accessing the sale. The notice also specifies the minimum acceptable bid for the property. Property information. The notice must include a description of the property and the name of the last assessee, the person or entity listed on the tax rolls as responsible for paying the property taxes. Redemption and rights of parties of interest. The notice informs the public that if the property is not redeemed by the last business day before the sale, the right of redemption will cease. The notice must also explain that if the property is sold, parties of interest, as defined in Section 4675, have the right to claim any excess proceeds from the sale. Handling of excess proceeds. If the sale results in excess proceeds, a notice will be sent to the parties of interest, informing them of their right to file a claim for the proceeds. Additional information. The notice must include details about subsequent sales if the property remains unsold, any deposit required to submit a bid, and information regarding the revival of the right of redemption if full payment is not made on a credit transaction. Conclusion for finders. Section 3704 provides a clear outline of the information that must be included in a notice of intended sale for tax-defaulted properties. For finders, this notice is essential because it not only signals when a property is about to be sold but also provides important details regarding excess proceeds, funds that may be available for recovery if the sale price exceeds the amount owed in taxes. By closely following these notices, finders can track when properties are nearing auction, when the right of redemption will expire, and when surplus funds may be available for their clients to claim. Understanding the content of the notice ensures that finders are well prepared to assist their clients in a professional and informed manner. Review of California Revenue and Tax Code Section 3704.7. Reasonable effort to contact owner-occupant of property. Overview for finders. Section 3704.7 mandates that the tax collector or their agent must make a reasonable effort to personally contact the owner-occupant of tax-defaulted properties if it is the primary residence of the last known assessee. This is important for finders to understand because it highlights the extra steps taken to notify homeowners before a tax sale. Although finders are focused on surplus funds and not on helping homeowners redeem their property, knowing these efforts can help finders explain the full process to homeowners and demonstrate their professional knowledge. Key provisions. Personal contact requirement. For properties that are the primary residence of the last known assessee, the tax collector must attempt to personally contact the homeowner between 10 and 120 days before the sale. This applies if there is a valid homeowner's exemption or if the mailing address for the tax bill matches the property address. During this personal contact, the tax collector must inform the owner that the property will be sold at auction if not redeemed and explain their redemption rights. Written notice if personal contact fails. If personal contact cannot be made after reasonable efforts, the tax collector must attempt to serve written notice at least 5 days before the sale. This notice informs the owner of the upcoming sale and urges them to contact the tax collector regarding the property's redemption. Costs incurred. The costs associated with these contact efforts are added to the total amount required to redeem the property. This additional cost may be relevant when calculating the total redemption amount. Bankruptcy notice. If the property is involved in a bankruptcy proceeding, the notice serves as a notice of tax deficiency under federal law, allowing the tax sale to proceed despite the bankruptcy. Validity of sale. Even if the tax collector fails to comply with the requirements of this section, the sale of the property is not invalidated. This ensures that procedural issues do not disrupt the transfer of ownership. Conclusion for finders. Section 3704.7 provides insight into the efforts made to notify owner-occupants about the impending sale of their property due to tax default. For finders, this is important because it helps them understand the full scope of the tax sale process. While finders do not focus on assisting homeowners with redemption, explaining this process can enhance their credibility and show that they are knowledgeable about every step leading to the sale. Additionally, once the property is sold, surplus funds may be available, which finders can help homeowners recover. Understanding how the personal contact and notification process works ensures that finders can offer a well-rounded, professional approach in their conversations with homeowners. Review of California Revenue and Tax Code Section 3706. Sale to highest bidder if property not redeemed. Overview for finders. Section 3706 governs the sale of tax-defaulted properties at public auction. This statute outlines the process that takes place if a property is not redeemed before the scheduled auction. For finders, understanding this section is important because it informs them about when properties are officially sold, which often triggers the potential for surplus funds. Knowing the mechanics of the sale process also helps finders explain the process to homeowners and anticipate when surplus funds may become available for recovery. Key provisions. Sale at public auction. If a property is not redeemed by the close of business on the last business day before the auction, the tax collector will sell the property to the highest bidder at the public auction. This marks the point where the property changes ownership due to non-payment of taxes, often generating surplus funds if the sale price exceeds the tax debt. Minimum bid requirement. No bid will be accepted for less than the minimum price set by the Board of Supervisors. This ensures that the sale covers the necessary tax debt and costs. The tax collector has the discretion to reduce the minimum price if a partial redemption or partial cancellation of the tax debt has been made after the price was fixed. This reduction is based on the ratio of the redeemed or canceled portion of the debt to the total delinquency. Conclusion for finders. Section 3706 is highly relevant for finders working in the post-foreclosure space, as it outlines the final step in the sale of tax-defaulted properties at auction. Once the property is sold, any amount paid beyond the minimum bid may result in surplus funds, which finders can help claim for homeowners or other parties of interest. Understanding the process of how properties are sold, the role of minimum bids, and the potential for price adjustments allows finders to better track auction outcomes and offer professional guidance to their clients. By focusing on this sale process, finders can position themselves as knowledgeable experts in the field of surplus fund recovery. Review of California Revenue and Tax Code Section 3706.1. Postponement of tax sale. Overview for finders. Section 3706.1 outlines the conditions under which a tax collector may postpone a tax sale, including public auctions and sealed bid sales. This statute is relevant for finders because it details how delays in the sale process are handled, which can impact when a property is sold and when surplus funds may become available. Understanding how and when sales can be postponed helps finders anticipate changes in the auction schedule and maintain accurate communication with homeowners or clients about potential surplus recovery opportunities. Key provisions. Postponement of public auction. The tax collector can postpone a public auction by making a public declaration at the originally scheduled time and place of the sale. If the sale is rescheduled within 7 days, no additional notice is required. This flexibility allows the sale to be delayed briefly without the need for extensive re-notification. Postponement of sealed bid or longer postponed sales. If the sale is postponed for more than 7 days but less than 90 days, or in the case of a sealed bid sale, the tax collector must follow the same notification process used for the original sale. This includes notifying parties of interest as defined in Section 4675, which ensures that anyone with a stake in the property is made aware of the new sale date. Conclusion for finders. Section 3706.1 provides flexibility for tax collectors to postpone tax sales, which can affect the timing of when surplus funds become available. For finders, it's important to be aware of potential delays in the sale process, as this may shift when they can begin assisting clients with recovering surplus proceeds. Additionally, knowing the notice requirements for postponed sales ensures that finders can track these changes accurately and keep homeowners or parties of interest informed. By understanding how these postponements work, finders can better manage their workflow and stay ahead in the tax sale process. Review of California Revenue and Tax Code Section 3707. Termination of right of redemption, revival. Overview for finders. Section 3707 deals with the termination and potential revival of the right of redemption for tax defaulted properties. This statute is very important for finders because it defines when homeowners lose their right to reclaim their property by paying off delinquent taxes and outlines how the right of redemption can be revived in certain cases. Understanding the specifics of this statute helps finders explain the process to homeowners and know exactly when surplus funds might become available after the property is sold at auction. Key provisions. Termination of right of redemption. The right of redemption ends at the close of business on the last business day before the tax sale begins. This is the final chance for homeowners or other interested parties to pay off their tax debt and avoid the sale. The sale is considered to have begun on the commencement date of the auction, even if the auction itself takes several days to complete. If the homeowner fails to redeem the property before the sale starts, they lose all legal rights to the property during the auction period. Revival of redemption rights. If the property is sold under a credit transaction and the tax collector does not receive full payment by the agreed date, the right of redemption is revived the next business day. This provides a second chance for the property owner to reclaim their property. If the property is not sold at auction, the right of redemption automatically revives, giving the homeowner another opportunity to redeem the property. Loss and regain of property rights. If the property is not redeemed before the final deadline, the homeowner or titleholder loses all rights, both legal and equitable, in the property. If the right of redemption is revived, the homeowner regains all rights to the property. Mail-in payments for redemption. Any payment mailed in for redemption must be received by the tax collector before the redemption termination time, regardless of postmark date. Completion of the sale. The sale is considered complete only when the tax collector has received full payment. If the property is not sold, the right of redemption revives. Conclusion for finders. Section 3707 outlines the final stages before a tax defaulted property is sold and the termination of the right of redemption. For finders, it is important to understand exactly when this right ends, as it signifies the point when surplus funds may be generated from the sale. In cases where the right of redemption is revived, finders should be aware of potential delays in surplus fund availability. Additionally, knowing the nuances of this process allows finders to professionally explain the homeowner's last opportunities to prevent the sale and what happens if the property is sold. This understanding ensures that finders can provide comprehensive and accurate information to clients, whether they are dealing with pre-foreclosure or post-foreclosure recovery of surplus funds. Review of California Revenue and Tax Code Section 3710. Content of deed. Overview for finders. Section 3710 outlines the required content of a deed that transfers ownership of a tax-defaulted property after it has been sold at auction. This statute is relevant for finders because it details the legal language and requirements for the transfer of property ownership, ensuring that the process is transparent and follows the proper legal framework. Understanding the content of the deed is essential for finders as it confirms the sale and can mark the point at which surplus funds may be available for recovery. Key provisions. Declaration of default and lien. The deed must specify that the taxes on the property were legally levied, declared in default, and became a lien on the property. This confirms that the sale was due to unpaid taxes, aligning with the tax foreclosure process. Statutory power of sale. The deed will state that the tax collector sold the property under their statutory authority. This ensures that the sale followed all legal requirements, giving the new owner a valid claim to the property. Objection by a taxing agency. If a taxing agency objected to the sale, the deed must include the fact of the objection and the name of the objecting agency. This adds transparency to the process and ensures that any disputes are noted in the public record. Purchaser information. The deed must include the name of the purchaser, the date of the sale, and the sale price. This provides an official record of the sale and verifies the terms under which the property was transferred. Legal conveyance. Finally, the deed confirms that the property is legally conveyed to the purchaser according to law, finalizing the transfer of ownership. Conclusion for finders. Section 3710 provides the essential legal framework for the deed issued when a tax-defaulted property is sold at auction. For finders, this deed not only confirms the sale but also signifies the potential availability of surplus funds if the property sold for more than the outstanding taxes and costs. By understanding the content of the deed, finders can accurately explain the sale process to homeowners or parties of interest, adding professionalism to their work. Additionally, the deed's provisions ensure that the sale and transfer of ownership are legally sound, making it easier for finders to track properties through the post-sale process. Review of California Revenue and Tax Code Section 3716. Report after sale. Overview for finders. Section 3716 outlines the reporting requirements that the tax collector must fulfill after a tax-defaulted property is sold at auction. This statute is relevant for finders because it provides insight into the formal steps taken after the sale, which can help them track when properties are sold and when surplus funds might become available for distribution. Understanding these post-sale procedures allows finders to stay informed about the status of properties and to anticipate when they can step in to assist with surplus fund claims. Key provisions. Reporting to the assessor. Within 30 days after the sale, the tax collector must provide a report to the county assessor containing key details about the sale. Required information. The report must include the name of the purchaser of the property, the date of the sale, the sale price, which may be relevant for determining surplus funds, a description of the property that was conveyed in the sale. Conclusion for finders. Section 3716 highlights the tax collector's obligation to report the details of a tax sale to the county assessor. For finders, this is important because it marks the formal completion of the sale process, after which surplus funds may be available. By understanding the timeline and details included in the report, finders can better track property sales, confirm when the property has officially changed hands, and identify opportunities to help clients claim surplus proceeds. This knowledge also helps finders present themselves as professionals who fully understand the post-sale process, further adding to their credibility. Review of California Revenue and Tax Code Section 3718. Deposit of money received from sale. Report of sale. Overview for finders. Section 3718 outlines the responsibilities of the tax collector after a tax-defaulted property has been sold. This statute is significant for finders as it clarifies how the funds from a sale are handled and how the financial details are reported. Understanding this process helps finders anticipate when surplus funds may become available for distribution and how the county manages the money collected from these sales. Key provisions. Deposit of sale proceeds. The tax collector must deposit the money received from the sale as if it were a normal tax collection. This ensures that all funds are processed through official channels and recorded properly. Reporting to county officials. The tax collector is required to immediately transmit a report of the sale to both the county treasurer and provide a duplicate report to the county auditor. These reports help track the financial aspects of the sale. Required information in the report. The report must include the cost of advertising the sale, such as the published notices required by Section 3702. The amounts received for individual parcels at the sale. A way to identify each parcel sold by year, page, and number from the delinquent and current tax rolls. The cost of recording the deeds, as these administrative expenses must be documented. Conclusion for finders. Section 3718 provides a clear breakdown of how the funds from tax sales are handled and reported within the county system. For finders, this statute is relevant because it tracks the money from the point of sale and ensures transparency in how those funds are managed. Knowing that the tax collector reports the sale details and deposits the proceeds promptly allows finders to follow up on when surplus funds might become available for recovery. This insight enhances the professionalism of finders, helping them explain the financial flow of tax sales to clients and ensuring they are prepared to assist with claims for excess proceeds. Review of California Revenue and Tax Code Section 3719. Deposit in County General Fund and Delinquent Tax Sale Trust Fund. Overview for finders. Section 3719 explains how the funds received from the sale of tax-defaulted properties are distributed within the county. For finders, understanding the breakdown of these funds is important because it helps clarify how surplus funds are managed and allocated after a property is sold. This knowledge enhances the professionalism of finders when they explain the process to homeowners or potential claimants. Key provisions. Advertising costs. The cost of advertising the sale, including the costs associated with publishing notices, such as those required by Section 3702, must be deposited into the County General Fund. This helps the county recover administrative expenses related to conducting the sale. Remaining funds. The remaining balance of the funds, after advertising costs and excluding the recorder's fee, must be deposited into the Delinquent Tax Sale Trust Fund. This trust fund holds the proceeds from the sale until they are properly distributed, which may include paying off outstanding liens and distributing surplus funds to rightful claimants. Conclusion for finders. Section 3719 provides insight into the post-sale financial management of proceeds from tax-defaulted property sales. For finders, it is essential to understand that after a sale, a portion of the funds goes to cover advertising costs, while the remaining balance is placed in a delinquent tax sale trust fund. This trust fund is where any surplus funds would be held, making it a key part of the process for finders who help claim these funds on behalf of clients. By knowing how and where the proceeds are allocated, finders can professionally explain the flow of funds and the availability of surplus proceeds after a sale. Review of California Revenue and Tax Code Section 3720. Mailing of duplicate report of sale, notice for claims. Overview for finders. Section 3720 outlines the process by which the auditor sends out a duplicate report of sale and issues a notice for claims to the appropriate taxing agencies. This statute is significant for finders because it details how different entities are informed of the sale, particularly those that may be entitled to a share of the proceeds. Understanding this process helps finders know when claims for surplus funds may arise and which agencies are involved in the distribution of those funds. Key provisions. Distribution of duplicate report. Upon receiving the duplicate report of sale from the tax collector, the auditor is required to mail a copy of this report to the governing board of each taxing agency, excluding the state and county, that is entitled to levy taxes or assessments on the property sold. These agencies may include school districts, special districts, or other local government bodies. Notice for claims. The auditor must include a notice for claims that provides a description of the property sold, a statement specifying that claims on the sale proceeds must be made within 60 days after the mailing of the notice. This notice is important for establishing a timeline for taxing agencies to claim their share of the proceeds. Agencies entitled to proceeds. The duplicate report and notice are sent only for properties where the taxing agency has consented to the sale and is therefore entitled to a portion of the proceeds deposited in the Delinquent Tax Sale Trust Fund. Conclusion for finders. Section 3720 provides clarity on how the sale proceeds are managed after a tax-defaulted property has been sold. For finders, this is important because it highlights the involvement of various taxing agencies in the distribution of the proceeds, which may include surplus funds. By understanding the timeline for claims and which entities are notified, finders can better navigate the process of identifying when and where surplus funds may be available. This knowledge allows finders to be proactive in ensuring all claims are handled professionally and according to the law. Review of California Revenue and Tax Code Section 3724. Distribution of money in delinquent tax sale trust fund. Overview for finders. Section 3724 governs the distribution of funds held in the delinquent tax sale trust fund after a property is sold. This statute is particularly important for finders as it clarifies how the proceeds from the sale are distributed among various taxing agencies in the state. Understanding this process is essential for finders to know when surplus funds may become available after claims from taxing agencies are settled. Key provisions. Board of Supervisors role. Once the share claims from taxing agencies are verified or settled, the Board of Supervisors must order the distribution of the proceeds from the sale. These funds are held in the Delinquent Tax Sale Trust Fund and are allocated based on the claims filed by the taxing agencies. Distribution to taxing agencies. The funds are distributed among the taxing agencies that have filed their share claims. Each agency will receive its rightful portion of the proceeds according to the claims process. State's share. A portion of the proceeds must also be distributed to the state of California. This amount is included in the next semi-annual settlement between the county and the state. Revenue districts. If a taxing agency is also a revenue district, such as a school district or special district, it will receive its share of the proceeds automatically, without needing to submit a share claim or receive a copy of the report of sale. This simplifies the process for certain agencies. Auditor's role. The auditor is responsible for issuing warrants from the Delinquent Tax Sale Trust Fund in accordance with the board's order, ensuring that all funds are properly distributed. Conclusion for finders. Section 3724 is key for finders who need to understand how the proceeds from a tax-defaulted property sale are distributed among various taxing agencies in the state. Once the share claims are settled, any remaining surplus funds may be available for claimants, making this stage of the process vital for finders working to help homeowners recover those funds. By knowing the steps for distribution and the role of the Board of Supervisors and auditor, finders can better track the status of funds after a sale and explain the process clearly to their clients. Review of California Revenue and Tax Code Section 4672.1. Distribution to reimburse county for cost of conducting sale. Overview for finders. Section 4672.1 highlights how counties are reimbursed for the cost of conducting a tax-defaulted property sale. This statute is relevant for finders because it explains how part of the proceeds from a sale are allocated to cover county expenses before any other distributions, including surplus funds, can occur. This affects the total amount of surplus funds available to claimants. Key provisions. Reimbursement to county. The county is entitled to receive $150 from the proceeds of the sale for each separately valued parcel of real property that is sold. This applies whether the property is sold to a private party or a taxing agency. Proceeds allocation. The $150 reimbursement to the county is paid from the total proceeds of the sale, but only after satisfying the amount specified in Section 4672, which typically covers delinquent taxes, penalties, and fees. If the proceeds from the sale are insufficient to cover this cost, the $150 reimbursement will be reduced accordingly. Impact on surplus funds. Since this reimbursement is deducted from the sale proceeds before other claims, it can reduce the amount of surplus funds available to claimants. For finders, it's essential to understand this deduction when calculating the potential surplus available after a sale. Conclusion for finders. Section 4672.1 outlines an important step in the distribution of proceeds from a tax-defaulted property sale, with $150 allocated to the county for each parcel sold to cover the cost of the sale. For finders, this affects the total amount of surplus funds available after all required expenses are paid. By understanding how the county's reimbursement is prioritized, finders can provide accurate information to clients about the remaining surplus funds that may be available for claims. Review of California Revenue and Tax Code Section 4672.2. Distribution of fee collected to reimburse county for costs incurred in giving notice. Overview for finders. Section 4672.2 provides details on how the county is reimbursed for the costs associated with providing notice before a tax-defaulted property sale. This section is important for finders because it explains how part of the proceeds from the sale are allocated to cover the county's expenses for giving notice, which can impact the total surplus funds available. Key provisions. Reimbursement for notice costs. The county is entitled to receive a fee to reimburse the actual and reasonable costs incurred in giving notice about the sale. This includes notices required by Section 3701, which covers notice to parties of interest, and Section 3799, which deals with various administrative notifications related to property sales. Allocation of proceeds. The fee for providing notice is paid from the total proceeds of the sale but only after the amounts specified in Sections 4672, which covers delinquent taxes and penalties, and 4672.1, which covers the county's sale costs, have been satisfied. If the sale proceeds are insufficient to cover the notice fee, it will be reduced accordingly. Impact on surplus funds. Since the notice fee is deducted after other necessary payments, this further reduces the potential surplus funds that may be available to claimants. Finders should be aware of this step in the process when calculating the potential surplus after a sale. Conclusion for finders. Section 4672.2 highlights that the county can deduct a fee from the sale proceeds to cover the costs of providing required notices before a tax-defaulted property sale. For finders, this is important because it affects the final amount of surplus funds available. Understanding how these costs are deducted ensures that finders can give accurate information to their clients regarding the total proceeds and the potential surplus available for claim. Review of California Revenue and Tax Code Section 4672.3. Distribution to reimburse county for costs of personal contact. Overview for finders. Section 4672.3 outlines how counties are reimbursed for the costs associated with personal contact efforts made before a tax-defaulted property sale. This reimbursement affects the overall distribution of sale proceeds and is an important consideration for finders tracking the availability of surplus funds after a sale. This section ensures that counties recover their costs for contacting property owners directly, as required under Section 3704.7. Key provisions. Reimbursement for personal contact. The county tax collector is entitled to be reimbursed for the actual and reasonable costs incurred in making personal contact with the owner of a property subject to tax sale. Personal contact is required under Section 3704.7 when a property is the primary residence of the owner and is subject to a tax sale. These costs apply to each separately valued parcel of real property sold, whether to a private party or a taxing agency. Allocation of proceeds. The reimbursement for personal contact is taken from the total proceeds of the sale, but only after the amounts specified in Section 4672, which cover delinquent taxes and penalties, have been satisfied. If the sale proceeds are insufficient to fully cover the costs of personal contact, the reimbursement will be reduced accordingly. Impact on surplus funds. Since these costs are deducted from the sale proceeds, this can reduce the amount of surplus funds available for claimants. Finders should be aware of this step when estimating potential surplus funds after the county's claims are settled. Conclusion for finders. Section 4672.3 ensures that counties recover their costs for the personal contact required before a tax sale. This deduction from the sale proceeds directly affects the total amount available in surplus funds after a property is sold. For finders, understanding these reimbursement processes is critical for accurately assessing how much surplus might remain after all county expenses are covered. By factoring in these deductions, finders can better advise their clients about the availability of surplus funds. Review of California Revenue and Tax Code Section 4673. Distribution to reimburse county for cost of advertising sales of tax-defaulted property. Overview for finders. Section 4673 covers the reimbursement to the county for the cost of advertising tax-defaulted property sales. This is another key step in the distribution of proceeds from such sales, as the county is entitled to recover these advertising expenses before any remaining proceeds, including surplus funds, are available. For finders, this means understanding how sale proceeds are allocated and what expenses are deducted from the total before surplus funds can be claimed. Key provisions. Reimbursement for advertising costs. the county is reimbursed for the costs associated with advertising the sales of tax-defaulted properties. This is an essential part of the public auction process, ensuring proper notice is given about the sale to potential buyers. Allocation of proceeds. These advertising costs are distributed to the County General Fund, as outlined in Section 3719, which governs how counties manage funds from tax-defaulted property sales. Impact on surplus funds. Since the advertising costs are deducted from the total proceeds of the sale, this reduces the amount of surplus funds available to claimants. For finders, understanding how much is deducted for advertising expenses helps in accurately estimating the potential surplus that remains after the county recoups its costs. Conclusion for finders. Section 4673 ensures that the county is reimbursed for the cost of advertising tax-defaulted property sales, with these funds being distributed to the County General Fund. Finders should be aware of this deduction from the sale proceeds, as it impacts the total available surplus funds. By accounting for these advertising costs, finders can better predict how much surplus will be left for claimants after the sale. Review of California Revenue and Tax Code Section 4673.1. Distribution after satisfaction of specified amounts. Overview for finders. Section 4673.1 lays out the process for distributing the remaining proceeds from a tax-defaulted property sale, after the county and other specified expenses have been satisfied. Understanding this distribution process is essential for finders, as it directly impacts the potential availability of surplus funds for claimants. Key provisions. Distribution after prior deductions. After satisfying the amounts specified in Sections 4672, 4672.1, and 4673, which include the costs for delinquent taxes, penalties, advertising, and sales, proceeds from the sale are distributed according to the priorities outlined in this section. Pro rata distribution. The remaining sale proceeds are distributed pro rata among various assessment funds and tax funds. First, proceeds are distributed to each assessment fund based on its proportionate share of the total assessments due. After assessment funds are paid, the remaining balance is distributed to each tax fund based on the applicable tax rates for the fiscal year before the sale. If there is an outstanding property tax postponement loan, the remaining balance is directed to the state controller to satisfy the unpaid balance. Satisfaction of current taxes. After the prior deductions, an amount necessary to cover current taxes, assessments, penalties, and costs for the fiscal year in which the sale occurs is distributed. This ensures that any taxes that would have been levied on the property, had it not been tax defaulted, are paid. Property tax postponement loan. If the property was part of the property tax postponement program, the outstanding balance of the loan is deducted from the sale proceeds. This includes the tax payments made by the state controller, accrued interest, fees, and penalties, minus any payments made on the loan by the property owner. Conclusion for finders. Section 4673.1 outlines how proceeds from a tax-defaulted property sale are distributed after certain specified costs have been satisfied. For finders, understanding this section is key, as it helps explain the various deductions made before surplus funds are available for distribution. Knowing the distribution order, including payments to assessment and tax funds, the state controller for tax postponement loans, and current taxes, ensures that finders can accurately assess potential surplus funds for claimants. Review of California Revenue and Tax Code Section 4674. Distribution of excess proceeds. Overview for finders. Section 4674 outlines the process for handling excess proceeds from the sale of tax-defaulted properties, which is the key focus for finders working in surplus funds recovery. After all prior costs and claims have been satisfied, the remaining funds are categorized as excess proceeds, which may be claimed by parties of interest. Key provisions. Excess proceeds defined. Excess proceeds are the funds left after all costs, taxes, penalties, and other expenses outlined in Sections 4672, 4672.1, 4672.2, 4673, and 4673.1 have been paid. These remaining proceeds are deposited in the Delinquent Tax Sale Trust Fund. Claims by parties of interest. The parties of interest, which could include former property owners, lien holders, or others with a legal interest in the property, can claim the excess proceeds under Section 4675. This is the critical opportunity for finders to help claimants recover their funds. Claim period. There is a defined period in Section 4675(e), during which parties of interest can file a claim. Finders need to be aware of this window to ensure claims are submitted on time. Transfer of unclaimed funds. If the excess proceeds are not claimed within the specified time, the county auditor may transfer the unclaimed proceeds to the county general fund. However, before the transfer, the county is allowed to deduct the costs related to maintaining tax-defaulted property files and administering the claims process, ensuring that these administrative costs are covered. Finder opportunity. This section emphasizes the importance of timing and accuracy when claiming surplus funds on behalf of property owners. Since unclaimed funds may be lost to the county, finders must act promptly and efficiently to ensure successful recovery for their clients. Conclusion for finders. Section 4674 provides the framework for distributing excess proceeds after all prior costs from a tax sale have been covered. For finders, this is the core of their business, identifying unclaimed surplus funds and assisting parties of interest in filing timely claims. Knowing the deadlines and ensuring all documentation is properly submitted is very important for successfully securing these funds for claimants. Review of Section 4675. Claim for excess proceeds, effective until the 1st of January 2025. Overview for finders. Section 4675 is highly relevant to finders working in the surplus funds industry. It defines how parties of interest can claim excess proceeds from the sale of tax-defaulted property, the process for making claims, and the priority of payments. Finders need to be familiar with these guidelines to assist claimants in filing valid claims. Key points. Claim process and deadline. Parties of interest, such as lien holders or former property owners, may file claims for excess proceeds within 1 year of the recordation of the tax collector's deed to the purchaser. Claims must be postmarked on or before the 1-year expiration date to be considered timely. Assignment of rights. Parties of interest can assign their right to claim excess proceeds, but only through a written, dated instrument. Both parties must fully disclose all facts regarding the value of the right being assigned. This transparency ensures ethical transactions. Improper assignments are considered void. Acting on behalf of a party of interest. Finders or anyone acting on behalf of a party of interest must submit proof that the party of interest was made aware of the source and amount of the excess proceeds, and that they were informed of their right to file a claim directly with the county at no cost. Distribution of proceeds. Excess proceeds are distributed by the Board of Supervisors in the following order of priority. First, to lien holders based on their priority. Second, to any person with title of record before the tax deed was recorded. Distribution of the proceeds cannot occur until at least 1 year after the tax deed is recorded. Rescinded sales in court proceedings. If the tax sale is under review due to a petition for rescission or a court proceeding, the distribution of excess proceeds will be delayed until the issue is resolved. Deceased claimants. If the person entitled to the proceeds is deceased, their heirs can submit a claim using an affidavit under the probate code. Legal review. Any challenge to the decision of the Board of Supervisors regarding a claim must be filed within 90 days. Conclusion for finders. Section 4675 is foundational for finders assisting clients with recovering excess proceeds. Finders need to ensure timely and accurate claims, understand the assignment rules, and adhere to disclosure requirements when working on behalf of a claimant. Moreover, knowing the priority of payments and possible delays due to court proceedings helps manage client expectations effectively. Review of Section 4675. Claim for excess proceeds, effective until and after the 1st of January 2025. The changes effective as of January 1, 2025, in Section 4675 bring some additional clarity and specifics to the claim process for excess proceeds. As finders, understanding these changes is essential to ensure compliance and smooth processing when assisting parties of interest. Key differences between the versions. Submission of claims. Old version, pre the 1st of January 2025, claims must be postmarked by the 1-year expiration date to be considered timely. New version, effective the 1st of January 2025, the claim process now explicitly states that claims can also be submitted through an independent delivery service, approved by the IRS or tax collector, and provides more details on how claims will be deemed received. The date of filing depends on the postmark or shipment date shown on the packing slip, adding flexibility beyond just mailing via USPS. Postmarking and filing process. The new version further explains that if no official postmark is on the envelope, the claim will be considered filed only when received by the county treasurer or tax collector's office. This detail helps avoid any confusion regarding the acceptance of claims without proper postmarks, ensuring a smoother process for both claimants and finders handling claims. Other provisions remain the same. Both versions maintain similar core aspects, such as the one-year window for filing claims, the process for assigning rights to excess proceeds, and the requirement for disclosure when someone acts on behalf of a party of interest. Distribution priorities, first to lien holders, and then to title holders, remain unchanged, as does the process in cases where the tax sale is petitioned for rescission. Conclusion for finders. The changes effective from January 1, 2025, bring additional specificity to the claim filing process, particularly with regard to how claims can be submitted via alternative delivery methods. These changes benefit finders by adding clarity to how claims are processed and filed, which helps avoid delays or issues when assisting clients. The rest of the section remains consistent, meaning finders can continue to rely on the same priority rules and assignment requirements when handling claims for excess proceeds. Review of Section 4676. Notice of right to claim excess proceeds. Section 4676 outlines the county's responsibility to notify parties of interest when excess proceeds from the sale of tax-defaulted property exceed $150. Understanding this section is crucial for finders, as it ensures that eligible parties are aware of their right to claim any remaining funds. Key provisions. Threshold for notification. If the excess proceeds from a tax sale exceed $150, the county must notify the appropriate parties of their right to claim these proceeds. Notification process. Within 90 days of the sale, the county is required to send written notice to the last known mailing address of all parties of interest, as defined in Section 4675. The county must make a reasonable effort to find this information. If the county cannot locate the last known mailing address, it must publish the notice in a newspaper of general circulation in the county, unless the cost of publication equals or exceeds the amount of the excess proceeds. The notice must be published once a week for 3 consecutive weeks, beginning no later than 90 days after the sale. Costs of notification. Any costs related to locating parties of interest, mailing, or publishing the notices are deducted from the excess proceeds and transferred to the county's general fund. Importance for finders. For finders, this section underscores the county's obligation to notify potential claimants. Understanding the county's process ensures that finders can effectively follow up on unclaimed surplus proceeds. If the county cannot reach the rightful parties, publishing the notice serves as another potential avenue for claimants to be notified, giving finders an opportunity to act on behalf of interested parties.